Welcome to the Fractional Show. Today I've got Scott Theeringer, who is the founder and CEO of MA DevCo. He is doing something absolutely mind-blowing in the land entitlement space. Scott, welcome. Excited to
Thank you
have you
very
here.
much. Glad to be here.
Yep, and Scott, just to kick it right off, I know you're starting an investment club on Fractional. Tell us a little bit more about what you're doing, what the club is about, the 60-second elevator pitch.
Well, what we do primarily is we find raw land and convert it into development opportunities. So that could be residential subdivisions, it could be multifamily projects, we even have commercial projects and industrial park. So our primary strategy is that we believe that the most value in real estate is created when you change zoning from one use to the other use. So that's where it's the most efficient use of capital, and it's where you create most of the value of a property.
Love that. And Scott, you've done $4 billion and more in commercial development, working with Dr. Horn, the Toll Brothers, Law&R. How does that really change, how you work and underwrite, especially when you've been operating at the institutional level on a land deal versus what, a private capital operator would do?
Well, I think first and foremost, I put myself through college doing construction and real estate. All my friends' dads were developers. The first time I got introduced to the strategy was when I was 18, and my best friend's dad was a real estate developer, and he had gone into a very nice area of town and had subdivided a piece of property and turned it into a luxury community, a luxury residential community. And I'll never forget, my friend said, "Hey, Dad, how much did you make today?" He said, "I made $1 million today on selling one piece of property." And so I was like, that's it. That's what I want to do. And so throughout my career, I went on to study econ and finance at Harvard and then went into the commercial lending industry. And when you look at thousands and thousands of transactions, you start to recognize patterns. And as I moved throughout my career, the project, really all that changes in you doing a project is the dollar figures get bigger. It's the same process over and over again. So you gain this knowledge and insight after looking at thousands of transactions and doing hundreds, if not thousands, of developments myself. You start to see patterns and recognize stuff, and you understand what the institutional investor wants versus the limited partner, mom and pop, smaller, retail investor wants. And there's everything in between. Smaller investors are looking for a higher return, but they still want it to be safe. Institutional level, it's all about safety. They're just trying not to lose the money and get some meek 6 to 8% rate of return because that's what their pension fund requires in order for them to keep up with the redemptions they're doing on an annual basis.
That makes a lot of sense. And it's so interesting because when I had spoken to some family offices, they actually told me, hey, we don't want to see anything higher than 10%. Like, that is a red flag to us. And
Yeah,
that is totally
exactly.
different from the conversations that you would have with a retail investor.
Which is completely counterintuitive as an investor and as an entrepreneur. Like, maximize return. They're like, no, that means risk. If there's risk, if the numbers are too high, we jokingly tell people, like, we don't want to, like, you don't never want to promise too much. But if you're also completely transparent with them, sometimes people just don't believe the returns that you can get when you're operating what we're doing.
Yeah, that makes a lot of sense. And Scott, I would love to just double click on, what does land entitlement even mean, right? I think especially for the retail investor, a lot of times we heard about multifamily syndications, fix and flips, all that, right? And versus what you're doing, the margins are so different, the operations, what exactly is land entitlement? Unpack that for us.
Well, it's really, entitlement is this word that's like this black box of this process. It's half legal, part engineering, part political. And really what we're doing is if you imagine the value of a property is only worth what you can put on top of it. So if I tell you and I bring you 50 acres of farmland and I tell you all we can do is either grow wheat or put some cows out there, what's the value of that property? And if I tell you that I've changed the legal use of that property to not be zoned rural farmland, but for a 40-story office building in downtown New York, what is that land now worth? So it's all worth what you can put on top of it. And really what they mean by that, it's worth the cash flows that you can receive off of it. You don't get much cash flow off of a cow eating hay compared to the cash flow you get off a major tenant leasing an office space. So really what we're doing is we're going to the city, we're saying we think the legal use of this property should be X, Y, and Z. Therefore, we want to change the legal use of the land, and now we've increased the value of that property. But we really take it one step further. We don't just do a zoning change. We go through the process of actually designing something that will go on site. Now, that could be an industrial park, it could be a mobile home park, it could be an office building, it could be a multifamily building, or it could be a residential subdivision. Any kind of design that gets taken all the way through the process, now you have what's called an engineered property or a fully designed property. Once you have those plans and you know specifically what can go on it, either legally from the zoning or actually with the physical building, now I can build a stream of cash flows around that building. And then you can take it vertical. So what our fund does is it goes out and finds those land opportunities, and we change the legal use into a specific private property, and then we go find someone to either sell it to or partner with to take it vertical.
That makes sense. And when do you decide whether or not to sell it versus partner with someone on the exit?
You know, it always comes down to the best and highest use of the property and whoever's going to pay the most. We do the underwriting on the front end to say, okay, we think that the legal use and the zone change is worth X. If we go in and do an engineered design property where we fully designed it, that's worth a little bit more. And then we look at, all right, if we were to take this thing vertical and fully build the project, what is that then translate into land value, and how much could we afford to sell it to ourselves effectively to be able to take it all the way through the cycle?
Makes a lot of sense. I'm curious, what is, the kill rate in terms of the deals that you're analyzing versus something that you actually say yes to?
That's a great question. We do thousands and thousands of mailers each month. We make thousands of phone calls a day. We do thousands of emails a day. And so there's a lot of outreach that we have to do in order to find and locate these properties. We're working with real estate brokers. We're searching all the MLSs, all the commercial websites for everything. We just kind of scour the entire market for opportunities. But we probably look at 5 to 7, maybe 10 properties a day that we say, okay, is this a potential property? And out of all of those, we'll write 2 or 3 letters of intent, LOIs, per week. And then out of that, on a monthly basis, writing 10, 12 LOIs, you get 1 or 2 contracts out of it. So we go from doing 10,000 forms of outreach to analyzing 40, 50 deals a month, narrowing it down to a half a dozen to a dozen LOIs to ultimately end up with 1.
Wow, that is mind-blowing. That is insane. And how many people?
It's a long, tedious process.
Yeah. What is like usually the average time frame between first touch point to the actual close?
That's a great question, because when we go to close on a property, we do a lot of due diligence. We'll actually put a property under contract because we don't buy unentitled farmland. We're not just buying land and then hoping that someday it changes. We actually structure the contract where we may have that property under contract for a year or 2 before we go through the entire legal process to make sure we can change it. We want to make sure the city is going to approve what we do before we buy the property. So it's not uncommon that you stretch out this long entitlement and due diligence process to make sure that you can do it. But from the time that we have the first initial touch point to get it under contract is about 30 to 45 days. And then once we get it under contract, it can be 12, 18, or even 24 months before we actually close on the property and finish the process.
That makes a lot of sense. I'm curious, during the due diligence process, has there been any crazy projects where your initial plan of where you thought it was going to go was completely different from what you actually found out? And how did that story finish?
Well, we have a project right now, actually, that we initially put it under contract. It's 8 condos that are clustered together in an area that's zoned for multifamily, MF3. And so when we looked at those 8 condos, we thought, okay, we can put a multifamily building on top. But this site was so small and so tight that we would have had to go subterranean 7 levels in parking in order to be able to park the building. Well, imagine driving at home at night and you got to go through this corkscrew to get all the way down. We said, okay, that's not going to work. So what we did is we actually designed a high-rise condo building. So we have a 24-story luxury high-rise condo building, because with those condos, those 44 condos that we have there, we don't need 7 layers of parking. We only need 2.5 to 3 layers of parking. And so we ended up taking something that we thought was going to be a multifamily site, and it's actually turned into a high-rise luxury condo project that is becoming a very unique, special thing for Dallas. It's in an amazing part of Dallas. It's in a high net worth area, and it actually just kind of, that's the beauty of a development, is sometimes things morph into things you didn't even think it would, but you could have never thought about it at the beginning and gone out, but you kind of, it's like a diamond in the rough. You kind of chisel away on it for a year and finally figure out what it can be, and then ultimately you've got this amazing jewel when you're left.
Wow, this is super fascinating. And how do these decisions get made? Is it, the structural engineer or the architect brings something to you and you all brainstorm? What is that like?
Yeah, it's really, I have a great team. Obviously, we have several project managers here. We have a real estate acquisition team, and me and my partner just we turn over the deal all the time. We say, can we do it this way? Can we do it that way? We immediately engage architects and engineers to help us design sites. And then we're sitting down with brokers saying, what is this worth? So what is the marketplace? What do you think it's worth? We take it, if it's a residential subdivision, we take it to the home builders. And we say, do you like product in this area? How big would you like it? What amenities would you like to see? How big do the lots need to be? How wide do they need to be? How deep do they need to be? What type of product do you want to put on top? So there are all these variables. So we're constantly, literally daily, talking about adjusting the game plan, adjusting the site plan, adjusting the financials, and constantly reworking the transaction until we get it all the way pushed through the entitlement process.
Wow, I love that. And Scott, I want to also talk a little bit about the capital stack. I know you've got preferred equity, there's the builder deposit, there's bank debt. Can you just walk us through what that structure looks like?
Well, typically when we call it going vertical, when we actually physically build something, that cap stack, the capital stack, is really just refers to all the different forms of money that's going to go in to finance the project. You'll typically have a bank that will fund somewhere between 65 to 75% of the value or the construction cost or cost of that project. So they call it LTC, loan to cost. The builders that we get deposits from, this is on the residential side, they'll actually give us millions of dollars in money upfront as a deposit, and they'll allow us to use that to help finance the project. The balance is what we call preferred equity. Some people call it mezzanine debt. So that's actually what we're doing with our fractional pref investment group, is bringing people in to make up that little slice of equity that's required in order to take projects vertical. So you've got the bank debt, you've got the builder deposits, and then you have the pref equity piece that's left over.
And how do you think about the pref equity piece in terms of, risk versus reward?
Well, I think the unique thing about pref equity is everybody understands the person that's in the number one position of being repaid on a project, it's not the bank, it's actually the federal government. The local tax man always gets paid first, right? And so then the next person in position that can't supersede the taxing authority is the bank. The bank gets paid. And then on a regular investment, it's the LP capital that's coming in, that entrepreneurial capital, that's what's at risk. And so with a pref equity group, you're actually getting a senior position to be pref equity. It's kind of like having a second on your house. You are actually in a position to where you're actually in a stronger securitized position than a limited partner or an LP investor is, because you're not coming on the top of the capital stack, you're coming in the middle. So that gives you a priority return. So let's say we do a project, we pay the bank off after we sell the project. Next in line is the pref equity people, the pref equity club. They get paid off, and then the developer makes their profit on top of that. If there's no profit left over, the pref equity group gets paid, the bank gets paid, the developer makes nothing. And so that's a way that they're kind of de-risked or de-leveraged in order to be able to make a more solid return than your traditional LP investor.
Yeah, that makes a lot of sense. And Scott, I know you traditionally, worked more with the institutional investors, and the club is, really definitely opened the gates to more people to have access. What was, the inspiration behind that?
Well, I think oftentimes when we get accredited investors in, our investment minimums on projects can be $100,000, $250,000. Some of our projects, the minimum investment's $1 million. And so that really is what a large family office or what you would call more of an institutional investor, that's their entry point. What happens to the guy that's not an accredited investor that only has $50,000? They don't get access to deal flow like this. When is that LP investor, that guy that has, maybe he's an HVAC contractor or is a real estate broker or someone who's saving that 50 grand, they have money, they want to participate, but they don't get access to all these alternative investments. And when was the last time they got to participate in a $100 or $200 million real estate project that's a major project and go alongside an institutional investor like the Related Company or Hill Communities, which is Ross Perot's company? They typically just don't get access. And through that investment fractional club, they'll be able to participate and invest alongside these major institutions.
Yeah, that's why we're super excited that you're opening the club. I mean, even personally for me as an investor, I told you day one, I'm like, I want to get into the club myself. Like,
Absolutely.
I've never gotten exposure into the strategy and asset class, and it's just so fascinating being able to have a seat at the table now and be able to participate. So I'm really, really excited about that. And Scott, I want to go back to, one of the first things that you said on the podcast. You said early on, you had a friend's dad, I think, that said, they made $1 million in a day, right? And that's what got you really intrigued about what this even was. I mean, looking at the home building value chain now, how would you stack rank the different pieces of it, and where does land entitlement come in terms of margins or risk reward, all the things you would think about as an investor and operator?
Well, if you look at the total development of a residential subdivision, for example, you have the land entitlement, which is the first phase. The second phase of that development process is the actual vertical construction of the lots, and then you actually have the house. So if I go to build a house, and individual investors can do this, you're going to build somewhere between a 15 to 20, maybe 25% on the high end profit margin to those homes. But you're going to have to go out there and you're only building a $400,000, $500,000, $600,000 product, maybe $1 million product on the high end. So which is a great investment for a single investor. But then when you try to do that at scale, you have to build a company. And it's no longer an investment, it's an operating company. And now you're competing with the likes of D.R. Horton, Lennar, KB, all the major home builders that have better buying terms, better bank rates. They can outperform you 10 to 1, and they also have the volume and the power to be able to put you out of business. So I think that when you're coming into this next level of transaction of developing the vertical lots, if you're a small investor, some of our projects, we're borrowing $10, $20 million, maybe $30 million to do a project. That's quite a bit of capital, and you have to have quite a bit of expertise in order to be doing it. I've been building and developing for 30 years. I've learned a little bit along the way. It's not that I'm that brilliant. You just have to be pretty dense not to recognize patterns and learn how to do something over 30 years. And so that's something to where that skill set, by partnering with us, you immediately get that skill set. But those people have to put that amount of capital and borrow that much money to get a 10 to 20% return as well. And then on the land entitlement, the economics are a little bit different. Is that we may only have to invest like $500,000 in order to get a $2 or $3 million profit. So the margins are 3 or 4 times what you would normally get on something without the same risk. You're not borrowing money. You're not having to finance stuff. You're not personally guaranteeing anything. So we deleverage all the risk down to just the entitlement process. And even more so by partnering with the builders and getting their earnest money and deposits. If they back out of a contract, we keep that money. And then we move on to another builder. So there's a lot of ways that we deleverage risk to be able to go in when you come into the fund. Diversification in the fund. If you build one house, you better hope that you built the right house and the right product in the right neighborhood for you to be able to sell that. With the fund, we may cycle through, like I said previously, hundreds of transactions before we find the good one. If you don't have that 30 years of experience, you don't know what a good one looks like. So better to partner with somebody who knows what they're doing and then partner with them to execute on that transaction.
That makes a lot of sense. And what is, the worst thing that you think could go wrong in a land entitlement deal?
Well, there's always unforeseen things. We say there's really no safe investment. If you're looking for a safe investment, go buy government bonds. The risk premium over the risk-free rate is just simply American bonds are what everybody uses as the risk-free rate. The risk-free premium is everything you get above that. So our fund targets north of a 30 IRR. Obviously, there's a little bit of risk in it, but the thing that can go wrong that would cause that risk is that you get an unwilling city or municipality that just absolutely says, no, we're not going to do it. In the kiss of death, in doing land entitlement or doing development, is you buy the land and now you have financing costs and carrying costs. And if you guessed wrong and the city tells you no for some political reason, which has happened, They decide that the community doesn't like development anymore, and it doesn't matter what the zoning code says or what the building code says. They're just telling you no because they want to get elected again next year. And that's not anything you can plan around. So by diversifying yourself with a fund that's looking at dozens of transactions, that's doing the due diligence to make sure you don't close on that property, we don't close on the property until we know we have it sold. So we have it under contract, we know we're going to sell it, we know the city's going to entitle it, and then we go forward and move forward with the transaction.
That makes a lot of sense. And is that why you're focused on the Texas Triangle? Are the policies, more pro and forward towards land entitlement? How has things changed over, the last couple of years as well?
Well, I think with COVID, we could have thrown a dart anywhere in the U.S. and landed in a cornfield in Iowa, and I would have been able to throw up a subdivision and someone would have bought it, right? So now when we talk to the home builders, they say really the only two great markets right now for them where they're deploying all their capital is Florida and Texas. We're based here in Dallas. We know Texas like the back of our hand. So that's why we created the Texas Triangle Land Fund, is because everybody's moving to Texas. We've got Y'all Street, Goldman Sachs is coming here. JP Morgan Chase just announced that they're coming. Morgan Stanley. So we've got all these financial institutions. The stock exchanges are all coming here. These are all extremely high-paying jobs that are all moving to Dallas. And what Dallas doesn't have is housing. Everyone's moving to Austin for the creative markets or the movie industry or tech industry, or it's kind of that creative culture that's down in Austin. It's got the university there. A ton of people are moving there. A lot of people move to Houston for oil and gas. So the population is moving from the coast inward, and that's really our investment thesis, is just get in front of the wave and provide the product that we know at night everybody needs a place to sleep. So that's what we're trying to do, is provide housing for people that are moving here.
Yeah. And Scott, you've obviously had so much success with, both your industrial fund and the residential fund. Who were, some of the investors that were part of those, and what was their experience like? Why did they join, right? Like, what were their financial goals? What were they looking for? And when they received their payouts, like, what kind of feedback did you get from those folks?
Well, I think that, most of the investors that we've worked with in our funds, on the industrial fund, we did that. It was all oil and gas properties. It was all oil and gas executives. And so it was literally, senior executives high up they don't want me to name drop. I don't want to say their name because they wouldn't want anybody to know that. But executives at ExxonMobil, at Chevron, at Schlumberger, at Halliburton, and Baker Hughes, all these major oil and gas investors. And so what a lot of people do is they're in the industry. The same thing on the residential side. Everybody wants to be part of these things, but they have a full-time job. They don't necessarily have time. We have a lot of doctors and lawyers and dentists and people that they know they want to be in real estate, but they're also smart enough to know that they're really good at their craft, but that somebody else can be really good at their craft too, which is real estate. And so that's what a lot of the makeup of our funds look like, is these professionals that are out there in the marketplace that need a place and want to be involved in something, but they can't necessarily go out every day and knock on doors and see if they can find a piece of property. So that's typically the investor makeup.
I love that. And it's one of my favorite questions, because I like to lean on the caliber of the investors that are, partnering with an operator, right? Because I trust smart people. If they're making bets with an operator, like, that to me is definitely a green flag for sure. And, definitely it makes me feel a lot more comfortable and excited to, partner with other really brilliant, executives, right, who are making these, big decisions, and you are one of the bets that they're placing on. So that's absolutely phenomenal. Yeah. And timeline-wise, Scott, what do things look like for the M&A DevCo club? What difference does it make? Why should someone join today, right, as opposed to waiting another 6 months?
Well, I think if we have investments right now that are coming out of the ground, and so these are cap stacks that we're putting together right now. And if people wait too long to get in, then they're just going to get closed out of the transactions, and it could be another 6 to 12 months before they're able to get into it. One of the crazy things about real estate is you push so hard to get it all ready to go, and then you're like, oh, we have to go now. Like, we've got 60 days to put this together. So a lot of the times the windows of opportunities to be able to invest are very tight. So if anybody's even considering getting in, we have a couple of projects that are looking to happen over the next 30 to 60 days that we are currently actively raising capital on, and those pref equity investors will be able to jump in on those transactions.
I love that. And what kind of communication and experience can people expect after joining the club?
Well, we have somebody specifically on staff named Anna who will walk them through the process. We also have a transaction coordinator in-house that will walk them through the paperwork, getting them onboarded, introducing them to everybody. And then as always, we also do email distributions monthly, giving updates. We have a quarterly investor call where we bring everybody on the call. We issue a quarterly reports, quarterly financials. And so there's a lot of communication that we do. We never like to leave investors in the dark about guessing what's going on. We try to do everything we can to educate them. I'll even take one-on-one phone calls with investors who just want to know how things are going. So we'll put something on the calendar. We call it virtually grabbing coffee, just so I can explain to them what's going on. This is what's happening. So that's the kind of a communication that we try to deliver.
The virtual coffees are the best. And I mean, I think just the level of transparency and collaboration you're willing to have with the investors, like that is one of the most important things to look for, in an operator to partner with. And Scott, what is, a few key messages that you'd love to leave to everyone that's, listening in, watching, and thinking about making a move? What's a final takeaway that you'd like to share with them?
I think for the investor at this level that's looking to come into a fractional club is you have to start someplace. Do not take on and decide that I've got a full-time job. I'm going to try to flip 2 or 3 houses. I'm going to try to take on these big endeavors when I've never done one before. I think it's better to dip your toe in the water, place a little capital, learn about the transactions, focus on what you do in order to maximize your income, and then take and set that money aside and invest it in something that gives you solid returns with a trusted partner. Work that process before you go out and say, I'm going to put $50,000 towards buying this house and work nights and weekends and put my kids and my relationship and everything at risk because I have to work for 12 months straight to flip this one house. I see it happen all the time. So for that initial small starting investors, learn on somebody else's dime, learn on somebody else's experience before you launch out and do things on your own. So focus on your craft, invest with a trusted partner.
Amazing. Lean on the shoulder of giants, right? And Scott, you're going to be that
Exactly.
giant for us. So super excited for everyone listening. Thank you for tuning in, and we'll see you on the inside.
Awesome. Thank you so much.